Hi, good afternoon, everyone, and thank you for logging in our call for the monetary policy. As you are aware, this was the last monetary policy for this calendar year, and we have Parijat Agrawal, head of fixed income, with us over here. So, without taking much time, Parijat, over to you. If you can give a quick overview on how you decode this monetary policy and the way going forward.
Thank you, Saurabh, and welcome to all our listeners for this edition of the December monetary policy. The measures which the MPC has taken and the way forward for MPC. So I'll share the PPT and then I'll explain. The way I have designed this one is that first we look at the measures, then what have been the factors which made MPC to decide on these measures. So I'll share. Just hold on. Is it visible or I need to?
Yes, visible. You can put on the slideshow more, Parijat, please.
Yeah, I'll do that selection. Yeah,
Yep, thanks.
yeah, is it visible? Slideshow?
Yes,
Yeah,
yes.
yeah. So now this policy. There was not any surprise from the MPC members. So last policy there was some surprise, but this MPC there was no surprise. So the repo rate remains unchanged at 6.5%. The STF rate also remains at 6.25. Accordingly, the MSF rate and bank rate remains at 6.75. So no change in the policy rate, the status quo. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target, which the MPC has highlighted is at 4%, while supporting growth. The decision was unanimous to keep the policy rates unchanged, but the withdrawal of accommodation stance was 5:1. Five members voted for and one member voted against that. So no change in the policy rates and no change in the stance, which was anyway on expected lines by the market participants. However, as we move ahead, let's try to understand why this decision was taken and what were the nuts and bolts which made the MPC members to take this decision. Yeah. So first, the was that look at the growth numbers. The second quarter GDP growth number came much above the anybody's guesses. So it came at 7.6%. Market was anticipating somewhere closer to 6.8 or at the maximum at 7%. So in line with the resilience and the optimism that we have seen in our GDP growth numbers, the MPC has done an upward revision for the full year of GDP numbers. So now it has been revised by almost 50 basis up for the full year. So in the last policy for the full year, that is FY 2024, the projection was 6.5. It has been revised 50 basis up to 7%. And similarly, this time the MPC has given for the next 3 quarters for the next financial years. So for the first quarter FY25, we have 6.7, second quarter 6.5, and for the third quarter FY25 it's 6.4. During the press conference, the deputy governor said that the number 7% is on a conservative basis. So the growth can surprise on the upside. That is what they mean by that. So that's a very, very good sign from the India's economic position that growth has remained resilient despite the global headwinds that we have seen. Now, what were the factors, which supported the growth, and the MPC had to, do an upward revision by 50 basis points? So it was largely driven by investment and government consumption. So if you, break up the growth numbers, it becomes very clear that it was driven by the capital expenditure, the investments the government has done, and also the government consumption which has happened. The manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. So, in fact, the 8 core industries, recorded healthy growth in October and continued their high growth since June this year. So, this time, what we have noticed is that the growth numbers are largely coming from the investment activities, and that too by the capital expenditure by the government of India. And the capacity utilization has also remained extremely high. It was 74.5% in Q2 of 2023-24 in the manufacturing sector, and it continues to remain above the long period average, which is 73.7%. So any number which is closer to 75 is very, very healthy, and it's like almost the economy is at full throttle, because any number at 80% means that the economy is at full throttle. Any number above that means that the economy is heating too much. So it is a good number in terms of the capacity relation. The investment activity continues to be aided by buoyancy in public sector capex, which I just mentioned. It is also visible in the GST collections, which is at 1.68 lakh crore in November 2023, and has remained buoyant for the last few months. The outcome of generally what happens is that when the investment cycle has been started by the capital expenditure by the government, it starts to have a spillover over a period of time, that the private sector capex starts to pick up. So that's what made the MPC very, very confident that India's GDP would continue to move along at a very healthy rate and upwards to of 7%. So this number could be revised upwards. This is as per the the expectations of the of the MPC members itself. Now, obviously, there are certain risks to the numbers just projected. The global economic slowdown is happening. What we have seen is that a lot of economies globally have started to slow down, which is visible. The consumption has started to slow down. In fact, this is visible in various numbers from the from the advanced economies. The tight monetary policy has started to have an impact in advanced economies, and the economy has started to slow down. It is visible both in the the investment and the consumption numbers. The volatility in financial markets is also a factor which can put us to the domestic growth numbers. The protracted geopolitical tensions have actually put can cause some risk to our GDP numbers. The high oil prices could definitely be a dampener in the growth numbers, although at this time they are extremely benign and close to $75 a barrel. Extreme weather conditions, they have continued to play havoc with the food prices that we have seen and noticed. That can continue to put challenges to growth numbers, because anyway, if the inflation starts to shoot up because of the extreme weather conditions, the room for the central banks to cut rates gets diminished. So there are risk factors, but at this juncture, it appears that these are minimal, and growth numbers look very, very healthy. The lot of high frequency leading indicators are projecting that the GDP is growing at a healthy rate. It can be upwards of 7%. One of the leading indicators is obviously your the credit growth. So now the credit growth has remained very, very robust. So the slide which I'm showing you, the chart shows that which is non-food credit, that YY change. So it continues to show that very robust numbers. It is at 16.2%. 20.6 is when you take that merger of HDFC. But if we take out the HDFC merger with HDFC Bank, it is at 16.2%. Similarly, we have seen that your deposit growth has remained very, very robust. It's at 12.9%. It is at the credit growth is a multi-year high on the back of economic expansion. We have seen increased capital expenditure, the implementation of PLI scheme, and a push for retail credit. Now, obviously, the number that we see is very robust. Obviously, if this number continues for a long period, it actually starts to heat up the economy. So a large part of the credit growth has been led by higher personal loan demand and increase in lending to NBFC segment. And in order to curtail this, we have seen that certain measures was taken by RBI by increasing the risk weightages for the these sectors. So credit growth in the personal loan space continues to be also driven by ministration of credit, that small ticket loan that we call it, less than 50,000, increased use of credit bureaus for faster decision, and increase in e-commerce transactions. So the number that we see here, in fact, in the press conference, the RBI governor explained that the corporate loan growth is at close to 12 to 14%, but this small ticket personal loan growth is upwards of 25%. So that's again, which can cause systemic risk. So that's why we've seen that, the recent measures to of risk weightages and other measures which the RBI has announced is in order to slow down this kind of unhealthy growth, because these kind of growths do not sustain and they cause systemic risk. But overall, the credit growth remains at multi-year highs. On the inflation side, which anyway is the mandate of the MPC to keep it, at 4% on a durable basis. So in terms of the inflation, the RBI's projection is at 5.4. They have maintained it at 5.4, and for the full year, and it has fallen to 4.9 in October. The November month data would come on 12th. So it had fallen from the high of 7.4 in July to 4.9 in October. So that has given a lot of confidence to the MPC to keep the rates on hold, because the 250 basis rate hike which the MPC had done has started to pass through in the economy, and that has worked its way through to keep the inflation or the disinflation momentum going ahead. The food prices have remained extremely volatile, and as I mentioned, the climate, the vagaries in the climate has continued to put food prices extremely volatile, which we have seen. And in fact, the numbers for the November and December, the headline inflation numbers, could remain elevated. It could be closer to 5.7 to 5.8%, or it could be closer to 6% because of uptick in food prices. So we have seen food prices started to move upwards again. So you see that number of measures by the government to control the food prices from the supply side shocks. So the ban on rice exports, or ban on the onion exports. So these measures have been continuing on a regular basis. So the volatility in food prices is going to be a challenge. It would keep the headline inflation volatile or in the upward momentum for the next 2 months. That's what is envisaged as of today. So in fact, the RBI highlighted that they are willing to look through these a few months of uptick in the headline inflation if it is driven by largely from the food inflation. But however, if this food inflation starts to get generalized and starts to seep through the whole basket of the inflation, then there needs to be taken some policy measures. But however, at this juncture, they do not envisage that. The another reason for the MPC to keep the policy rates unchanged was that the 250 basis rate hike has actually started to disinflate the economy from the demand side pull. So what we have seen is that core inflation, which is the inflation minus the headline inflation minus food and fuel, has started to moderate. Basically, the manufacturing and the services inflation has started to moderate, and it is moving towards the 4% mark. So that is again very comforting news for the MPC members and for the economy, that it has the higher food inflation has not generalized into the overall headline inflation. So that has given a lot of room for the MPC to keep their policy rates unchanged, and that's one reason that they have kept the for the full year the inflation projection at 5.4%. For the next three quarters in the next financial year, they have projected at 5.2 in first quarter, 4% in second quarter of FY25, and again 4.7% in FY25. So what we see is that the projection for inflation is that it starts to trend downwards. So that's a very comforting sign for the India's economy, that food inflation and the overall core inflation has started to trend downwards. Now, if you look at the various data points, so as I mentioned, the headline inflation moderated to 4.87 in October. The core CPI moderated to 4.23 in October 2023, and it is expected to move towards 4% mark in a gradual fashion. The moderation in global commodity prices has actually helped us in terms of moderating of core inflation, because the pass-through of input prices is no more a necessity for the producers. So because if you see that food prices, they have fallen substantially from $85 a barrel to close to $75 a barrel as I speak to you. The disinflation in core gathered momentum during September-October and reached levels last seen during Q4 of 2019 and 2020 due to combined effect of policy rate increase and reduction in cost push pressure across core goods and services, what I just mentioned. So it is expected that because the global demand has actually come down from the global economy, so the upward pressure on crude prices which we had seen has started to diminish. That's why the crude prices are closer to $75 a barrel. So it is expected to remain closer to those levels, maybe between $75 to $80 a barrel, which is again within the RBI's calculation for the overall inflation projections. And let me tell you that these prices of $75 a barrel are despite the OPEC Plus reducing their production. It is at they have reduced it by 1.8 million barrels per month. So despite that, because the weaker demand, and also during the winter months the demand has been weak, so it clearly tells us that global demand for the oil has moderated. So going ahead, inflation outlook would be considerably influenced by uncertain food prices. So that's what basically the underlying theme is, because it has remained volatile, and we have seen the vagaries in terms of the climate. So excess rain, or drought, or the cyclone, or any other factor which we have seen. So that has kept the food inflation highly volatile. Obviously, there are key risks to our projections in inflation. So adverse weather condition is the most important factor today in terms for the food inflation. Supply side shocks can continue to manage because of the geopolitical risk. The oil prices can shoot up again, or because if the Israel-Hamas war becomes broader, or the entire the Middle East gets involved, so it can happen. Increase in food prices if it's on a sustained basis, and the global commodity prices, not only oil but other global commodities also start to move up. Now, in terms of the growth, we have seen very comfortable. Inflation is also moderating. The third pillar for any monetary policy tool is liquidity, because this is how you influence the monetary policy measures for their transmission. Liquidity is a big tool for transmitting the monetary policy measures. So in the last policy, we saw that the government, the MPC announced that how they expect the systemic liquidity to be comfortable, and so they will have to do open market option sales to manage the excess liquidity. However, despite their projections of moderating liquidity, the system liquidity tightened significantly, much more than what the RBI had envisaged compared to an October policy. Hence, the need to take open market operation sales did not arise. So that was one reason that last time for the RBI emphasized that they'll have to undertake open market operation sales, but liquidity tightened much more than it was envisaged. And a large reason for this was that obviously the currency in circulation increased much more than it was envisaged by the RBI. So the entire 3.62 lakh crores which was deposited of 2,000 rupee note, in fact a substantial part has come back into the the circulation again through the various other currency notes. So that is again was much more than it was envisaged. And in order to smoothen the the liquidity because it has tightened much more it was envisaged, what RBI has realized that there is skewed liquidity in the system. So sometimes the banks are parking money in both the STF, which is at 6.25%, and also at MSF. They're borrowing from MSF at 6.75%. So they have allowed, because this was a banking, the banks had demanded this from the RBI for a very long time, that they decided to allow reversal of liquidity facilities under both STF and MSF, even during weekends and holidays with effect from December 30, 2023. What it means is that if you have deposited in STF and also borrowed from MSF, they can do the reversal during holidays and also during the weekends when it is shut, the markets are shut. So that it would allow for a better management by the of the funds by the banks. This measure would be reviewed after 6 months or earlier also, and it would start from December 30, 2023. It is expected that it would ease off this the excess tightening that we have seen in the banking system as of today to a certain extent. And one more measure which would help us, or the banking system liquidity, or rather I would say that it would give a confidence to the FIs, is that RBI and Bank of England have signed a memorandum of understanding to assess CCI for recognition as a third party counterparty for UK-based banks to clear their transaction through CCI. So that's a very positive step. So the other countries of the Eurozone would follow this step, and it would give a lot of boost for the FIs to do business with the Indian banking system or to settle their deals in the domestic system. However, let me also emphasize that we expect the liquidity to remain tight in the near term, because these measures which RBI has announced will come from December 30th. So we'll have advanced tax, GST outflow and other measures would be there to keep the liquidity very tight, and the overnight rates are expected to remain closer to 6.75, between 6.75 to 6.80 at least in the next fortnight. Only by the end of this month, when the government expenditures normally happens by they start spending in during the month end, or also this is a quarter end, we could see some expenditure by the government that would ease the liquidity to a certain extent. But one thing which the RBI governor mentioned also here is that to understand that the OMO sales that is not off the table, it remains a tool, but there was no need to conduct OMO sales, so they have not done. But yes, as and when the need arises, they will do that. But as of now, it doesn't appear that they would resort to this tool. Looking at the external sector, in October 2023, both merchandise exports and imports came back into the expansionary zone. The services exports remained buoyant during Q2 2023-24. and India has remained the top remittance receiving country. So the net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. See, this is one, normally we talk about the twin deficits, current account deficit and fiscal deficit. So current account deficit, normally is expected to remain within 2.5%. If it is within that range, it is expected that it is extremely manageable and very healthy. So with the remittances remaining very, very, healthy, in fact, being a large number, it is expected to offset current account deficit to a large extent. So any, the shortfall or the because of the our imports are much higher than the exports. So any merchandise, trade deficit is expected to be covered by the remittances. So that would help the current account deficit to remain manageable. On the financing side, foreign portfolio investment flows have seen a significant turnaround in 2023-24 with net FPI inflows of $24.9 billion. That is up to December 6, as against net outflows in the preceding 2 years. So that tells you that globally the FIs are extremely bullish on India. So because our economy is moving at a very healthy rate, it is one of the top growth countries in the world today. At closer to, if it happens at 7%, it will be the top country. So it is giving a lot of confidence to the FIs to invest in India. India's external vulnerability indicators, which is external debt to GDP ratios, reserves to external debt ratio, reserve cover of imports, these all exhibit higher resilience in comparison with emerging market economy peers, as well as since the taper tantrum period. So in fact, one of the questions asked in the press conference was that, what if this $25 billion inflow happens because of the inclusion in global indices, bond indices, and if there is outflow. So obviously, when it happened, the outflow was $25 billion during the taper tantrum in 2013. The same can very easily manage today. We have a large buffer of $604 billion. $604 billion in the forex reserves. The inflows are very healthy and our external debt ratios are very comfortable. So that's not much of a concern. And as of December 1st, our foreign exchange reserves at $604 billion. So that's a very comfortable position in terms of the external sector we have. So that also gives lot of comfort to MPC to put on hold the policy rates. Normally, otherwise, it puts pressure on your INR, and that when in order to manage the pressure on the INR, you have to hike the rates. So that's also one factor which gave a lot of comfort or room for MPC to keep the policy rates unchanged. Now, this was a domestic factor, what I just mentioned to you. These domestic factors are also driven by what is happening globally. So I have just put one slide on US CPI inflation and 10-year yield. So let's look at this, this chart. So the orange line depicts the US CPI inflation. It had touched close to 9.1%, and with the tightening there by the US Fed, and at 5.5%, it has started to work through their economy, and we see that the US CPI inflation has fallen to close to 3.2%. So from 9.1 to 3.2. So that clearly tells that the US Fed is not going to hike the rates, and that's also coming through the various data points in terms of their the wages and the other growth numbers. So that also gives a lot of room for our MPC to say that yes, we can put on hold. Similarly, if you see the US yield, the 10-year yield which you have charted here, which the blue line, it had touched close to 10%, and with the various data points which are coming from the US, it is close to 4.18. So a fall of close to 80 basis points from the peak at 5%. So the external pressure from the US of the from the dollar side of higher yield and higher rates is also diminished. So that also puts a lot of perspective in terms of our domestic policy. Now, there were some very important statement on development and regulatory policies. First was that the review of regulatory framework for hedging of foreign exchange risk. As of today, what we have seen is that the traders are not, or the exporters and importers are not hedging their foreign exchange risk because of very low volatility, because RBI has been managing the volatility in such a way that rupee trades in a very narrow band. So obviously RBI wants to make sure that nobody is caught unguarded, and so they are going to do some changes in their master directions in respect of all type of transactions in the foreign exchange. That is from the prudent aspect of managing your hedging risk. The unified regulatory framework on connected lending for all regulated entities to avoid moral hazard. Basically, it is that the lenders are not influencing the the credit behavior. Basically, it is the RBI is trying to talk about that. So some regulatory framework would come on that. There has been some regulatory framework for web aggregators of loan products to increase customer centricity and enable borrowers to make informed choices. So first we saw that some regulation came on risk weightages for the NBFCs and the banks for lending to that unsecured loan, that personal loan. We saw that. Then came peer-to-peer lending, which we just saw that RBI has raised concerns about some practices which is not in line with the regulations. So they are going to tighten these kind of easy lending through various regulatory measures. There was some enhanced UPI transaction limit for the medical and education services, and exempt requirement of additional authentication for e-mandate. Those regular transaction frameworks have been done. Establishment of cloud facility for storing financial sector data. As of today, the cloud sector, the financial sector data is stored on cloud, and these clouds are outside India. So obviously, the risk increases. So the RBI is going to create some kind of facility where this financial sector data is stored on cloud in India only. So that is a long-term project, or medium to long-term project, which they are going to undertake. And today, the fintech sector has expanded its footprint across, and obviously, it has to be, the growth has to be in an orderly fashion. So RBI has asked for setting up a repository to capture essential information about fintech, their activities, products, technology stack, etc. So that to encourage to provide information voluntarily rather than through the regulations. So what we understand is that going ahead, do not envisage any rate hike by the MPC, and rather the MPC is going to manage the inflation and the rate tightening through macro prudential measures, like as I just mentioned, or we have just seen through the regulatory measures of in terms of personal loan growth, or the risk weightages, or repositories, or any or other measures. So macro prudential measures would be coming in a big way, so that there is no systemic risk going ahead, and the monetary policy measures which the MPC had undertaken of hiking by 250 basis points is not derailed by systems or measure or lendings which are happening outside the system. So that's where we envisage a lot of measures would come in going forward. Now coming to the overall picture and putting everything in perspective together, in terms of the fixed income markets, why they look very good today, why there is a lot of value in fixed income markets today, and why investors should invest in fixed income instruments today. The real policy rate continues to be positive, and because repo rate is at 6.5, and with liquidity being tight and with various macroprudential measures, the short-term rates have remained elevated. So projected inflation is also at 5.4. Going forward, it is expected somewhere around 4 to 4.5. So you have sufficient real yield, in terms of the policy rate and inflation. So that gives a lot of room for MPC to cut rates. Global central banks have put a pause on rate hikes or are on the last leg. As I just showed you the US chart of their inflation and yield. RBI to ensure adequate liquidity for productive requirements, and our forex positions are comfortable. So RBI would continue to intervene or manage liquidity on the both end, neither sufficient nor extremely deficient. External debt ratios are low by international standards, and so that's why we expect a lot of bond flows which would come in from the June onwards, when the JP Morgan global bond indices starts to kick in. So that would not pose a lot of risk to us. Core inflation has remained benign, expected to fall further and to be in a very, very comfortable zone for RBI. However, uncertainties in food prices would definitely play one small spot, but RBI is or MPC is willing to look through for a few month data points. And the base effects are likely to lead to pickup in headline inflation in November and December, but RBI governor highlighted they are going to look through these 2 months of data of uptick in headline inflation. Geopolitical risk and global inflation trajectory, as I mentioned, that global inflation trajectory is on a downward path, and it has started to fall across the global economies and geographies. So markets are expected to remain volatile in the near term. That is going to be order of the day because the rate cycles have become shorter. But if you look at the overall picture, the absolute yield levels are still attractive from a medium to long term. So you have a very healthy accrual. So if you'll ask me, a 2 to 3 year corporate bond, AAA PSU bond, gives you 7.8 to 8.5. And with the rate cut on the horizon in the next financial year, somewhere in the second half, you can take a ballpark figure, of a very healthy return, even if there is a 50 basis rate cut going forward. So with a duration of 3, you can add those numbers. It could be upwards of 8%. So a very healthy accrual and MTM gains. So total holding period returns is going to be very attractive. And for investors who are willing to take or stomach volatility, long bond, I would say upwards of 10 years, give you very, very attractive returns in the medium to long term. So I will give you one perspective that the 30-year bond, like 2053 GSEC, is at trading somewhere around 7.5%, and which has a duration of closer to 12 years. So if you have a 50 basis rate cut in the next financial year, so you can add up what kind of return you can generate, in a year's half time. To end up, the MPC outlook, I would reiterate what Governor Das mentioned in his statement, that we should not get carried away by 2 months or a few months of good macroeconomic data points. Similarly, we should not tighten too much that it starts to pose risk to our growth. So what we understand is that the rate cut cycle looks largely over, but yes, there would not be any rate cut going soon, very soon. The RBI or the MPC would look for concrete data points to get comfortable to start reducing the rates, and that would happen, in our view, in the next financial year, somewhere in the second half of next financial year, when we could see the headline inflation moving towards actually in 4% zone, that is between 4 to 4.5. So as of now, bond markets have a lot of value to give to investors in terms of accrual, plus income gains. So that's all in the MPC and the outlook. Thank you.
Thank you, Parijat. So you have answered quite a few questions in your talk. So the question, when do we see the rate cycle reversing? So like you said, second half of the next financial year
Yeah.
is probably when we are looking at the rate cycle reversing. The next question is, by how much you are looking at the rates to come down?
See, again, as I mentioned, one can expect somewhere around 50 basis point. It may not happen in one go, but yes, 25 to 50 basis is what we look at this point. See, this would definitely depend upon how the incoming data points are. So, the projections for how much rate cut would happen would depend upon how the global economy is also shaping up and how the US Fed is behaving. So, it would depend on a lot of factors, but yes, one can say that 25 to 50 basis could be there.
The next question is, what's your view on chances of the Indian government bonds being included in Bloomberg Emerging Markets Index?
See, as I mentioned, which in my is that the inflows, the FPI inflows have been positive. They were negative in the last 2 years. That clearly shows that a lot of comfort and faith the FPIs are having in India, and with India moving at 7% upwards. So RBI mentioned that it is on conservative side. I'm very confident that it would happen in Bloomberg also. Obviously, these are a lot of work goes on. So because as I had mentioned in my last NBC or Outlook also, that once it happens in one index, JPM, the work becomes much easier for other indices to include because the investors are largely the same. So it would happen in Bloomberg also. The timing could be again difficult to say, but Bloomberg index is a global index. It is not emerging market. So there, even if the weightage is somewhere around 0.6 to 0.8, that would inflow is close to $25 billion. So 25 JPM, 25 Bloomberg. So you can add those numbers.
The next question is that recently the rupee have been under pressure despite dollar index, not doing well. So what's the reason for that?
See, yes, the dollar index has actually fallen closer to 103. It has fallen from 107. So obviously, one expects that the rupee would also continue to fall. There are 2-3 things. As such, the dollar shortages has remained because of the what we have seen globally, which is happening because of the QT, which is happening globally, and RBI has been intervening quite frequently in the forex market to manage the volatility, and with the merchants not hedging their risk also, that also puts pressure on because nobody is hedging. So the demand on one leg remains, but the other leg is not done. So that has kept the the pressure on the INR, and it is expected to remain like this going forward, because it would ease once the domestic liquidity also eases. So all these factors combined put together has kept the pressure on the INR.
Thanks, Mike. The next question is, the interest rates have been high for some time now, and the GDP is growing. Wouldn't it be a scene that interest rate don't come down at all, and this becomes a new base of interest rate? Because ideally, the interest rate for moving up, growth should have come down. On the contrary, the GDP numbers are moving up every quarter. So, is it likely that this interest rate becomes a new base?
I will put it in this perspective. See, the GDP numbers that we see today, these normally, you expect that if the growth is very high, inflation will come back. This is normally, expectation that higher growth, higher inflation, you all talk about. Yes, it happens because the urban demand has remained resilient, and demand from rural economies has also started to pick up. But there's one change this time in terms of GDP numbers. It has been largely because of capital expenditure and investment activities. It is not from your fiscal and your entirely from consumption, and very healthy your capacity relations. So that gives us a lot of confidence to say that this will not get generalized in your core inflation, which you have seen in the numbers. What we have seen in the inflation numbers is because of the food, and that is going to remain volatile, and that would be, can be controlled by the supply side measures the government takes. So what we expect is that the GDP numbers are looking good, but obviously the GDP numbers base would also change. It would not continue to grow at 7% or 7.5% on this base also. So obviously what we expect is that when the global growth starts to slow down, it would definitely impact our domestic growth numbers also. We cannot remain in isolation. Yes, we would continue to do very well, but not the numbers that we see today. So yes, there would be rate cuts, but the extent to rate cut would definitely depend upon the incoming data points. So what we expect is that there is lot of room for a rate cut to happen, despite the GDP data numbers showing very healthy numbers, because it is not getting generalized, because this time it is more from the capex and investment activities.
Thanks, Mike. The next question is, do you see US Fed changing the stance soon?
As per the interest rate probability, somewhere in terms of May, it is expected that they will start to cut rates. That's what the markets are building in. And that's why we saw that the US fell, 10-year fell from 5% to 4.14%. So yes, it is still some 6 months away or maybe slightly more, but not in the near term, because they would also like to see whether this was not one-off, the data points which are coming in. They would also like to see that it is on a sustained basis.
What's the yield on a corporate bond fund right now?
Corporate bond yield, just hold on, let me just hold on, I'll tell you. Corporate bond yield is 7.75 to 7.85. That's the range.
So the question which is being asked is that between a GSEC and corporate bond for next 2 years or 3 years, right? Obviously, the GSEC will give a higher return because of a higher duration in case of
right.
market gain. But expecting a 50 basis point rate cut, what will be the impact on the corporate bond fund?
We run a duration of close to 3.
Okay.
So you can calculate.
Yeah.
So with a accrual of 775 and a duration of 3, with a 50 basis rate cut, you can add. And similarly, in gilt fund, the YTM is close to 7.25, but we run a duration of 6.3. So you can again add up there.
Okay. Thanks, Parijat. I think we've covered all the questions, and thank you again for joining in the call.
Thank you.